The JMF Advisors Show is a podcast for business owners, C-suite executives, and entrepreneurs who are looking to build, grow, or even exit a business.
We bring in some of our best financial advisors to interview experts on business best practices, hot topics, and sprinkle in some tax and accounting help.
If you're a business owner, startup founder, CFO, or just starting your side hustle, this podcast is for you.
Hello, and welcome to another episode of the JMF Advisors Show. I'm Rachel Taylor. This is Kristi Moore. We're both shareholders at JamisonMoneyFarmer, primarily do tax, and we are here with another great tax topic today.
Yeah, today we're talking about the provisions of the Tax Cuts and Jobs Act, which is often referred to as the TCJA. Those are set to sunset at the end of next year, 2025. So we're talking about all the different provisions that we expect to be exiting at the end of 2025 and talk about some tax planning that can be done now and some things to keep in mind going forward. So a little bit about the TCJA. The Tax Cuts and Jobs Act was signed into law in December of 2017 by President Trump, with most of those provisions being effective in 2018. And it was designed to increase take-home pay for workers, increase levels of business investment and GDP, and simplify the tax code, which is always comical to say.
For sure.
It was a significant overhaul to the Internal Revenue Code of 1986. And so we'll talk about the different provisions, starting with the individual tax provisions that were part of that act.
Yeah, it's easy to forget what things were like before because it feels like we've had this particular act for a while, which I know in reality we really have. So it is helpful to remember what's set to change.
Right.
May not.
That's
we don't know
right.
what may happen.
We'll see. Huh?
We'll see. But if nothing happens, this is what will change. So the top tax rate today is 37%. It will go back up to 39.6%. And the other tax rates will also shift. We won't go into the minutia of that, but if you're in the kind of the 12, 22, and 24%, those will go up a little bit to 15, 25, and 28. So a couple percentage points.
2 or 3%.
Yeah, even if your income stays the same. So that's a big one. Even if nothing else changes, obviously, if the rate changes, then your tax will change.
Yeah.
Another big one that we have seen have a big impact on tax returns is the standard deduction.
Yeah.
So before, lots of people itemized, but since this act took effect, I feel like 80% of people don't itemize anymore.
Sure.
It may even
Right.
be higher than that. And the reason is because it doubled. The
Right.
standard deduction at the time about doubled when the Tax Cuts and Jobs Act took effect. It increases for inflation every year. So for 2024, if you're married filing jointly, the standard deduction is $29,200.
Which is significant.
That's a lot.
Yes.
I mean, you'd have to have a lot of itemized deductions to exceed that. And if you're over 65, it's even higher.
Right.
So therefore, most people don't itemize anymore. We do still for Alabama, but not for federal. So starting in 2026, the standard deduction for married filing joint would go back to $13,000, but that would be adjusted for inflation. So it wouldn't be, that's just what it was.
Right.
It would be adjusted, but obviously not to almost 30,000.
Sure.
So those are two pretty big ones.
And there were a lot of changes in the TCJA that affected itemized deductions.
Yeah.
So with the standard deduction changing, there are also, when we calculate itemized deductions, a lot of changes to each of those.
Yep.
One notable change was a limitation on the state and local tax deduction. It brought in a cap of $10,000 on those state and local tax deduction. So that includes property taxes, the little bit of tax you pay on your car tags, and then, of course, the state tax that's paid by taxpayers. So this affected business owners a good bit that had pass-through entities. So we saw a lot of states adopt the pass-through entity option for small businesses. And so that cap will go away at the end of 2025 as it currently stands. And so it'll be interesting to see what happens with that. And, business owners, I guess, will have to reconsider that pass-through entity election that's been made and whether to revoke the election or, what happens.
I have thought about that same thing because,
they'll no longer have the cap on their individual tax. So is it worth
Right.
having that election. So
One more thing to consider.
Yes. We'll see what happens there.
Yeah.
Then another one that was impacted was the mortgage interest deduction. And so there was a limit placed on, and it just affected new mortgages since really the passage of the bill or the act in 2017. So any new mortgage entered into after that December 16th, 2017 date, the mortgage interest is limited to just the interest on a mortgage of $750,000.
Yeah.
And so that threshold goes back to $1 million, which was the limit before the that cap, so, or that limitation. Yeah. So that's a beneficial change in that case, or both of those were.
Yeah.
Then another change was the home equity loan interest deduction. And so the TCJA limited the interest that's deductible for a home equity line to funds that were used to buy or build or substantially improve the taxpayer's home. And so that limitation goes away at the end of 2025, and then it falls back into the limitation of just $100,000 of home equity debt.
Yes.
So that is one other change. And then another itemized deduction that changed with the TCJA was a limitation on, or the elimination, I guess, of most of the miscellaneous itemized deductions that we were able to take advantage of in the past. So a lot of those will come back, or we expect them to, including the investment fees that are deductible, legal and accounting fees for personal reasons, and then unreimbursed employee expenses, which is something that, you know, some taxpayers were able to take advantage of. Of course, those are limited to 2% of the taxpayers at AGI, but some people will be glad to see those come back, I think.
I still get asked about those.
Yes.
I think people forget that those have gone away. So some people will be glad they're back.
Yeah.
Because they didn't realize they were left.
That's right. And then some of the other items that changed for individual taxpayers was the child tax credit. And we were able to benefit from the $2,000 per child tax credit over the last several years. And so once TCJA goes away, it goes back to $1,000. You know, who knows if that changes with some other passage of a bill.
It could.
But we shall see, as with any of these, I guess.
Right.
And then personal exemptions were limited as part of that act. And so, eliminated.
Yeah.
And so we'll get those personal exemptions back. At the time, they were $2,000 per taxpayer, but we expect them to be adjusted for inflation. So I think it's expected, if we had them in effect at this point, they'd be about $4,700. So having those back will help combat some of the other changes that we're seeing. And then one other big change that we talked about was the alternative minimum tax exemption and the phase out. The TCJA increased the exemption amount for AMT to a level that I think when we talked, we see very few clients that have faced the AMT since this change.
That's right.
So it will go back to the lesser exemption levels, and so that'll be interesting to see. Get to do those fun AMT calculations and discussions again.
Yeah, could mean more people in AMT.
Correct.
Sounds like.
Correct. Yeah. So that will be interesting.
Yes. I mean, that's a lot for individuals.
It is a lot of changes,
and some good, some not so good, which makes planning difficult.
It does.
Because
it does.
You don't know which side's going to win.
Absolutely.
Probably the not good side, but
that's right.
We'll see.
Yes.
So not as many on the business tax side, but a few. One, I guess one of the few, maybe the only one that's permanent, that's not scheduled to sunset, is the corporate tax rate for C corporations. So the top tax rate used to be 35%, and now it's changed, flat rate of 21%. So that's not changing. So that was designed to help American businesses and all that. So that one's not changing. But a big one that is changing, that's going to affect a lot of folks with pass-through entity or sole proprietorship income, is that qualified business income deduction. So without getting, I mean, we could do a whole podcast on that.
Yes.
So, but there's a 20% deduction on qualified business income,
Right.
which for a lot of people is whatever their ordinary income is from their business. Not necessarily, but that's kind of where you start with the calculation. So 20% of that for a lot of people is very significant.
It's quite significant.
Yeah,
yes.
it makes a big difference on their tax return. So and when 2025 ends, so does this QBI, as we call it, deduction. So that's a big deal.
I imagine that one will get a lot of interest as far as
yes.
pushing some of our lawmakers to make a change because,
Oh, yeah.
C corporations are getting to keep their
That's right.
beneficial rate of 21%, but that pass-through entity benefit of the QBI was set to try to level the playing field for those pass-through entities. And when that goes away, that'll be
Yeah, that's a good point.
interesting. So
Probably a lot of special groups are
Yes.
going to be interested in that.
absolutely.
Bonus depreciation, I feel like people are way more aware of bonus depreciation. It's a gradual sunset. It's
Right.
already started to sunset, really. In 2024, starting in 2023, it went down to 80% deduction instead of 100%. We got 100% when the TCJA started, but then it was a gradual 20% decrease. And that first decrease happened in 2023 for property purchase then.
Yeah.
Going to go down to 60%, all the way down to 0. But it actually goes past. We get a little bit in 2026. You get 20% in 2026.
Hanging on to for one more year.
Completely gone in 2027. So that may change. There's, we thought that might even have already changed. So that may change. But
There were
that's
some proposed
yeah. I thought it might pass,
changes.
but
Yeah.
but no. So that's another one. Those two are going to affect businesses a lot
Yeah.
for sure if they don't change.
Yeah, and then of course, many of you may be aware of the estate and gift tax exclusion that was increased significantly with the TCJA. It was virtually doubled, I believe.
Yeah,
And so,
I think
so the limitation or the estate tax exclusion for 2024 is $13.61 million per individual. So for a
Yeah.
married couple, you're talking about over $27 million. And for 2020, at the end of 2025, that exclusion goes back down to the normal, I guess, probably indexed amounts, but it'll be roughly cut in half.
Yeah.
And so there's a lot of planning going on right now for those that could benefit from some planning. And so I would advise folks to not wait too late to do that planning and talk to your state tax advisor about things you can do to plan for that decrease, because once that doubled exclusion goes away, it can impact your heirs, basically.
Yeah, because you mentioned you're hearing that from some attorneys
Yeah.
that they're already overwhelmed in a
Yes.
way with
Yes,
with
with
this,
planning
even
for
though
this.
it seems like it sounds like it's far away, but
Right.
from a planning perspective, it's not.
Yeah.
So yeah,
In some cases, there's a lot of steps to take to
right.
get to the point where you're able to benefit from the current exclusion.
Can't be done quickly.
That's right.
So that was a lot.
Yeah.
That's a lot of stuff. There's probably even some more minor things that we didn't mention. These are just the big ones. So, of course, the question is, well, what do we do now?
Yeah.
Like, what do I do with this information? Where do I go from here? We've mentioned it a couple of times. These are all set to sunset as it stands today, but with an election coming up, with, you never know what may change. There could be, sometimes we get last minute reversals of laws that are sunsetting. So all of this could change, but it's still helpful to plan,
Absolutely. Yeah.
because if you don't have to implement your plan, then that's okay, but at least you're prepared.
That's
so
right.
most people, I say people, if we're talking about individuals here, so not necessarily businesses, most people probably should prepare for a tax increase, because if you recall, you probably got a tax decrease when this was enacted. The tax withholding tables changed. You
Right.
probably had a little bit less withheld. So you had more coming home every month. That's probably going to change,
Yeah.
I would expect, with the tax rates changing. So we ran a few scenarios. So these are all very high level, not a lot of detail here, but it just gives you kind of an idea. So our first scenario would be a married couple. Their not take home pay, but their income is about $200,000. They have 2 kids. They take the standard deduction. Okay. So their taxable income actually would go down because they get the personal exemption back. But because of the child tax credit change, it goes down, but also the threshold goes down. So fewer people are going to be able to take it.
Yeah.
So their tax still goes up, even though the taxable income goes down. So their decrease in take-home pay is about 2.5%. So they'd be taking home 2.5% less every pay period, roughly. Okay, so that's scenario one. That's pretty common.
Yeah.
So I feel like that might affect. That's probably most people might find themselves in that boat.
And for those type people that are on W-2
Yeah.
wages, in your scenario, they'll probably start feeling that in
Yes.
January 2026 because we would expect the withholding tables to change to account for the increased tax rates. So
That's right, which in a way is good. That
Yeah.
means when you file your tax return, you won't be stuck with this
That's
big
right.
bill, but
That's
you're going to feel it.
they're going to feel it a
quicker.
little bit sooner.
Yes, that's right. That's a really good point. So same thing with this scenario too. Single taxpayer, wage income, W-2 earner, $250,000, no dependent, taking the standard deduction. Same kind of thing. Their taxable income actually increases because it's just a single person. You don't have the kids in there. Tax rate, so that's kind of a double hit because the taxable income goes up and the tax rate increases. So the decrease in take-home pay is about 3%-ish in that case. So a little bit higher, not a ton, but still enough that you probably notice it,
Yeah, I imagine.
Okay, so then we went a little bit more high income here. So scenario 3, married couple making $800,000, all wage income, 3 kids. In this one, we tried to add in some itemized deductions because if your income's that high, you may have a high mortgage, a lot of mortgage interest. Maybe you've got a lot
Higher
of state
state
tax.
tax.
Yeah,
Yep.
property taxes possibly, state income taxes paid. So we're going to assume that these people are itemizing still. So we got that. But so their taxable income, they benefit from that, the removal of the SALT tax, state and local tax limitation.
Nice.
So that's good.
Okay.
But still, you come back to that tax rate going
Yep.
up. And so their decrease in take-home pay is about 4% because their income is going to be way too high for any kind of child tax credit.
Right.
So even with the benefit of maybe increased itemized deductions because of the state taxes, they're still stuck with that higher tax rate. So that's something we'll see a lot.
Right.
But they'll feel it in their take-home pay.
Right.
Not like this fourth one. Okay. So the fourth one, married couple, $500,000 of business income. But in this situation, we're assuming it's not wage income, it's business income, pass-through entity, maybe sole proprietorship, something like that. 2 kids, itemized deductions in this case too. Okay. So this one gets the QBI. Maybe something like
They have been getting the QBI, right?
Yeah, right. That's right. That's an important distinction.
They're going to lose the QBI.
In their previous
supposedly.
life,
Right.
they got the QBI.
Yeah.
And potentially of like $100,000, right?
A nice size amount.
Yeah, if your business income is $500,000, if you get the full 20%.
Right.
So that's eliminated. That's a huge hit for these people. And your tax rate increases. So they're going to see a decrease in take-home pay of like 6.5%.
Yeah.
Not really
Wow.
take-home because it's going to be different than the wage people.
They're likely
but-
paying quarterly estimates or
Right.
something like that. Yeah.
So I guess you could assume there that your estimates are going up.
Right.
Not really your take-home
Right.
pay is going down, but same general principle. So
their net tax balance basically is
right.
tax liability, I should say.
So if you
going up by
didn't
that.
plan ahead when you get your 2026 tax return,
Yikes.
you might be a little upset.
So you've got a nice size check to write. Huh?
Right. And but for you, you're not seeing a paycheck decrease. So
Right.
you might not really feel like anything's changing
Right.
till you file your tax
Right.
return.
A
So-
good reason to be talking to your tax advisor, especially during 2025.
Right. Yes, for sure. For
to
sure.
Start planning for these things. And
Which, if enough people are paying attention to this, then some of this stuff will probably change.
yeah,
But
that
I
would
mean,
be our hope.
no guarantees there. But
That's right.
Those are just some scenarios. Everybody's a little different.
Mm-hmm.
But yeah, as you mentioned, a great time to talk to tax advisor as we get closer to this and figure
Right.
out which one of these do you fall into?
Yeah.
How concerned do I need to be? So
Well, and one thing, we talked about is what can I think about in 2025 preparing for these changes in 2026?
Yeah.
Is like, is there some income that I can push to next year? Are there
Yeah.
some take in 2025.
Right.
Push deductions to 2026. Are there any things that, and a lot of things it's just normal course of business or
Yes.
whatever. You can't determine when, or affect the timing of some of those income and deduction items. But if you can, hopefully there's some planning and just some thoughts. Of course, it would just sort of be a 1-year advantage to
Right.
to push some deduction into 2026. But it's something to think about, and maybe by then, again, we've got some new tax law or something like that,
Yeah.
that's reconsidering some of these benefits that we've enjoyed for several years now.
Yes, absolutely.
Some other things that, assuming all stays the same and headed into 2026, that people could consider. You mentioned the loss of the bonus depreciation for businesses. Another option for 100% depreciation is Section 179 depreciation that we've had for many, many years now. Of course, it allows you to write off 100%. With some limitations, of course, but it does have an addition limitation. So for a really large business or one that made significant asset additions, they may be limited. But
Yeah.
Otherwise, you can take a nice size amount of depreciation through 179. So that'd be one thing to consider. For individuals, you can maximize your retirement contributions to try to lower your taxable income.
Yeah.
And then, of course, there's qualified charitable distributions that retired individuals could use to shift some retirement, some taxable retirement income over to a charity.
Yeah.
So rather than making the contribution directly to a charity, they could decrease their taxable income at the same time. So those are just some things that could be done in 2026 that may help some. But again, we've got an interesting few years probably ahead. We never get used to the tax law as it stands because it's there's always going to be some changes or, like you said, talk of changes to come. So I know we had some proposals earlier this year that just haven't gone through. So
Right.
We'll see what happens maybe after the election. So
And if we're lucky, it won't come through on, December 29th or something like that.
or even January 29th.
Right. That's right. We've been through all of those.
We have.
Maybe we'll
Keeps
get
it fun, right?
Yeah, that's right. Job security.
Yeah.
But yeah, hopefully we might get a little bit more advance notice. But
That's right.
you just never know. Things get stalled, and so we'll just plan for whatever may
That's
come.
right. That's right. Plan and then wait and see.
Right.
Yeah.
And edit.
Yes. Well, thank you for joining us today. Thanks for your insight, Rachel.
Yeah,
and
thank you.
We hope that you'll check out our other podcasts, follow us on YouTube and podcast app, and so that you get notifications about other topics, and stay in touch with your tax advisor. Thanks.
Thank
Bye-bye.
you.
If you would like us to help your business or would like to suggest additional podcast topics, simply send an email to info@jmf.com.
And don't forget to subscribe to our podcast on YouTube and your favorite audio podcast apps.